Liquidity in an age of speed. It used to arrive with time to think. Orders placed, pauses allowed, consequences unfolding slowly enough to understand. Now liquidity appears and disappears in milliseconds, reshaping markets before human judgment can even react. What once felt solid has become fleeting, and the speed itself has become the risk. To understand why liquidity matters differently today, we need to look at how markets learn to move faster than decision-making. Technology compressed time. Digital trading replaced physical exchanges. Capital began flowing at machine speed, responding to signals rather than intentions. Liquidity was no longer just availability. It became responsiveness. The ability to enter and exit instantly became the defining measure of safety. This transformation changed behavior across the system. Traders assumed they could always sell. Funds structured strategies around rapid repositioning. Institutions relied on continuous market access rather than balance sheet strength. Liquidity felt abundant not because assets were stable, but because markets were always open and always active. But speed reshaped the nature of liquidity itself. In calm conditions, markets became deeper and more efficient. Bid-ask spreads narrowed. Volumes surged. Prices adjusted smoothly. The system appeared resilient, even elegant. Yet this smoothness masked a critical shift. Liquidity was no longer stored. It was borrowed from future, dependent on constant participation. The moment participation slows, liquidity evaporates. Algorithms withdraw. Market makers step back. Orders vanish before they can be filled. What looked like depth reveals itself as motion. And motion, once interrupted, leaves nothing behind. Early warnings surface quietly. Sudden price gaps during minor news events. Flash volatility that reversed within seconds. Markets recovering quickly, but only because speed masked instability. Each incident was treated as a glitch rather than a signal. The system moved on faster than reflection allowed. In an age of speed, liquidity feels permanent because it is always present, until it isn't. And when it disappears, it does so instantly, without warning, without negotiation. The very mechanisms designed to protect participants can amplify stress when conditions change. These opening signs point to a deeper tension. A system that moves faster than understanding may function brilliantly in calm moments, yet become dangerously fragile under pressure. Liquidity, once a buffer against risk, is now inseparable from it, because when markets outrun human response, the question is no longer how fast capital can move, but whether stability can keep up. As speed became the defining feature of liquidity, the structure beneath markets quietly shifted. What once depended on patient capital and deliberate judgment now relied on continuous participation from machines designed to react, not reflect. Market makers adjusted algorithms in real time. Funds optimized strategies around milliseconds. Liquidity transformed from a reserve into a behavior. This shift created an illusion of depth. Order books appeared full. Prices updated constantly. Large trades executed with minimal friction. Until conditions changed. Liquidity was no longer anchored by commitment, but by willingness. And willingness, at machine speed, can vanish instantly. High-frequency systems thrived in this environment. They supplied liquidity during calm periods, tightening spreads and increasing volume. Their presence reassured markets, reinforcing the belief that liquidity was abundant, but their logic was conditional. When volatility rose beyond thresholds, withdrawal was automatic. There was no discretion, no judgment, only code responding to risk signals faster than any human could intervene. Traditional institutions adapted to this reality. They reduced inventory. They relied on markets rather than balance sheets to manage exposure. The cost of holding risk grew, while the cost of exiting fell, at least in theory. Over time, resilience shifted away from preparation and toward reaction. Stability became something markets were expected to provide themselves. Early stress tests revealed hints of vulnerability. During sudden shocks, prices moved sharply despite high trading volume. Liquidity fragmented, flowing freely in some assets while disappearing entirely in others. Markets reopened quickly, but the pattern was clear. Speed amplified both recovery and disruption. Regulators took notice, but faced a new challenge. Oversight tools were built for institutions, not algorithms. Market rules assumed human pacing. Circuit breakers slowed trading, but could not restore liquidity once participation withdrew. Intervention lagged behind events that unfolded in seconds. For investors, behavior changed subtly. Risk tolerance narrowed. Stop losses tightened. Strategies assumed rapid exit as protection. The belief that one could always get out became central. Even as everyone relied on the same assumption, the system grew more sensitive to synchronized behavior, more vulnerable to sudden shifts in sentiment. Liquidity in an age of speed is not something held. It is something performed continuously. It exists only while participants remain engaged. And when engagement depends on algorithms calibrated for calm, the system becomes exquisitely sensitive to surprise. This was the quiet escalation. Markets optimized for efficiency, not endurance. They moved faster than oversight, faster than understanding, and faster than trust could adapt. The conditions were set for a conflict where liquidity itself will become the source of instability. The conflict emerges the moment speed collides with uncertainty. A sudden shock, unexpected news, a sharp data release, a rapid shift in sentiment. Yet the market calibrated for smooth motion. Algorithms react instantly, pulling back from risk. Liquidity thins before humans can even register the change. What was deep a second ago becomes shallow in the next. Prices begin to gap. Orders chase disappearing bids. Volatility feeds on itself as withdrawal triggers more withdrawal. The same systems that once stabilized markets now accelerate instability, not out of panic, but out of logic. Each algorithm is doing exactly what was designed to do: reduce exposure when conditions deteriorate. The problem is that they all do it together. Institutions relying on continuous liquidity find themselves exposed. Trades cannot execute expected prices. Hedges fail to align. Risk limits are breached faster than managers can respond. The speed that once felt protective now removes the time needed to adapt. Decisions that once unfolded over minutes now resolve in milliseconds, leaving no space for correction. Market makers face an impossible trade-off: stay active and absorb losses, or step back and preserve capital. In fast-moving environments, stepping back is often the only rational choice. But when enough participants do the same, liquidity collapses entirely. The market does not break. It empties. Regulatory safeguards struggle to keep pace. Circuit breakers pause trading, but pauses do not create buyers. When markets reopen, uncertainty remains. Liquidity returns unevenly, cautious and fragmented. Confidence does not reset with the clock. It must be rebuilt through participation that cannot be forced. Public perception reacts sharply to these moments. Headlines focus on sudden drops and unexplained swings. Trust wavers, not because fundamentals have changed, but because the system feels unpredictable. Stability, once associated with constant motion, is revealed to be conditional on calm. Inside the system, the realization sets in: liquidity supplied at speed is fragile by design. It performs brilliantly when conditions are stable, but withdraws instantly when they are not. The faster markets move, the less tolerance they have for surprise. This is a turning point. Liquidity is no longer just a market feature. It becomes a source of systemic risk. The very mechanisms designed to ensure smooth trading amplifies stress when alignment breaks. And once confidence in speed erodes, restoring it requires more than faster systems. The system now stands at its most vulnerable point, not because it lacks liquidity in normal times, but because it cannot guarantee liquidity when it is needed most. The reckoning arrives when markets accept the truth they long resisted. Liquidity at machine speed is not resilience. It is a conditional promise, honored only while conditions remain familiar. When uncertainty enters, speed does not absorb shock. It transmits it. In response, the system adapts, but not without cost. Regulators expand safeguards, introducing pauses, buffers, and stress protocols designed to slow runaway reactions. Markets are forced to acknowledge that friction, once seen as inefficiency, is sometimes the only thing preventing collapse. Stability begins to favor restraint over velocity. Institutions rethink their assumptions. Balance sheets regain importance. Holding risk becomes preferable to relying on instant exit. Liquidity planning shifts from constant availability to worst-case endurance. The idea that markets will always provide a way out is replaced by a harder truth. Sometimes, there's no exit at the speed demanded. Technology evolves as well. Algorithms are redesigned to recognize stress, not just price movement. Participation becomes more conditional, more deliberate. Speed remains, but it is tempered by rules that prioritize continuity over optimization. The goal is not to outrun uncertainty, but to survive it. For investors, the lesson is sobering. Liquidity is no longer a guarantee. It is a behavior shaped by incentives, thresholds, and confidence. Strategies adjust. Risk tolerance changes. The belief that speed equals safety begins to fade. Looking back, liquidity in an age of speed reveals a paradox. Markets became faster to reduce risk. Yet in doing so, they narrowed the margin for error. Stability was achieved by motion, not by depth. And when motion stopped, nothing remained beneath it. The enduring insight is simple but uncomfortable. Liquidity that disappears when it is needed most is not liquidity at all. It is optimism measured in milliseconds. True resilience requires time, commitment, and the willingness to endure discomfort. Because when markets move faster than trust can follow, slowing down is no longer a weakness. It is the only way to keep the system standing. Subscribe to join the journey. Liquidity